Welcome back to the Pursuit of Progress podcast, the podcast where real estate meets self improvement and smart strategy. I'm Adam, here with my co host Ben, and today's episode might ruffle some feathers. And that's because we're talking on one of the biggest names in personal finance, Dave Ramsey. We're diving deep into why his advice on mortgages, down payments, and home ownership, while once helpful, just really doesn't fit the 2025 market. And worse, why following it blindly could cost you hundreds of thousands in missed opportunities, lost equity, and definitely some time that you're never going to get back. This isn't just about disrespect, it's about reality. The housing market has definitely changed. Rates, wages, home prices, none of it looks like it did back in 1995. So today we're going to unpack the 9 biggest pieces of mortgage advice that Dave Ramsey gives, and more importantly, the smarter real-world strategies that we see actually working every single day. All right. Wow, that was a mouthful, but hopefully everybody's pumped as much as I am to hear Ben share a lot of great mortgage nuggets with us today, some fire that he's going to drop today. So I'm excited for this one. Ben, what is up, dude?
I'm so glad to be here. And you're right. We are probably going to ruffle feathers. Dave, same thing. This isn't about disrespect. I love Dave. I think Dave is right for America. I just happen to disagree with him on this specific topic. But when you start talking about these things, people get really upset because he kind of has an army of followers and they all believe the same thing the same way. We're not here to tell you to do something a certain way, but we want to present what some of our concerns are and share why his approach, what I believe, is no longer relevant in 2025 when it comes to mortgage.
Quick little side note. I actually went and saw Dave Ramsey live. It was probably about 15 years ago now. There was a book he came out with that I really enjoyed called Entre Leadership. So instead of entrepreneur, Entre Leadership, and just really got a lot of value out of that book. And shortly thereafter, I finished it. He actually was coming through Denver on this kind of speaking tour and bought tickets with my old business partner. We went to it, and I'll tell you what, yeah, you talk about this, like the army of followers that he has, definitely some very kind of loyal, I don't know what words to use for it, but kind of like almost like a Tony Robbins type event where people were very, I think for good reason. I think a lot of people probably their lives were changed because of Dave. Yeah. So, inspiring, but definitely a very specific type of person that he's targeting. And I think that, like you said a second ago, it's kind of maybe that older generation that just really does not apply to what we're dealing with today, and especially here in Denver, Colorado.
Yeah, one thing I love about Dave is that I don't think he's aged a day in the last 30 years.
Have you seen some of those like Instagram reels where it's sharing like him on his radio show where people are calling in and, Hey, Dave, yeah, I've got $250,000 of debt and I haven't told my wife. It's from gambling. What should I do? Those types of stories. It's like, oh my gosh, I'm sure he's heard his fair share of just insane scenarios.
Oh yeah, absolutely. And being in the mortgage world, I've seen my fair share of crazy stories. I don't always get the backstory, but I get to see just when I'm going through financials. I see the credit report, what the debts are, the credit card debt. I don't know how it got there, what happened, but I do get to see the financial chaos at times. So that's why I say, he's very passionate about, the thing that Americans struggle with is consumer debt. Credit cards, student loans, auto loans, those are the things that eat up monthly cash flow. They're tied to depreciating assets or no assets at all. And my values and beliefs really align with his when it comes to consumer debt. But when it comes to mortgage debt, I truly believe, I'm more of like the Robert Kiyosaki side, the Grant Cardone side. I believe that that's good debt. I believe if you leverage something that is going to go up in value and produce cash flow and you're doing it in a responsible way and you have options and flexibility, that can be a good thing. Most people, though, the masses, they don't think like that. They just have a different perspective. And so that is where Dave Ramsey steps in. I wanted to just start off, though, with this quote that I wrote down for this week from Carl Richards, where he's talking about risk. Risk is what's left when you think you've thought of everything. That's why blindly following cookie cutter advice can be dangerous, especially in real estate. It's not about being reckless. It's about being informed. And that's exactly what we're trying to do here today. We're just trying to inform you, our listener, so you can make an informed financial decision based off of what you feel is in your best financial interest. That's it.
That's great. Well, with that, let's just jump right into the main content. So, we're going to be talking again about 9 mortgage myths that could be costing you. These are all things that Dave Ramsey's passionate about that Ben and I are going to be pushing back on today and just urging you guys to kind of be critical thinkers and make up your own mind on some of these specifics. So, jumping right into myth number 1, only get a 15-year mortgage. So, why 15-year loans sound smart? There is some, understanding why that is the case for some people, why they feel that's better. But in 2025, they often just don't work. With the 30-year, it really does just give you a little bit more flexibility. It's not locking you in. Cash flow isn't really a weakness. It's really more about survival. Ben will just kind of share a few kind of pointers on this one with us.
Yeah, the whole point of a 30 years, typically the 30 year is going to have a lower interest rate, and that's still true today, but it's not it's not crazy lower than the 30 year. It's typically a half point. So if the 30-year fix is at 7%, the 15-year fix might be at 6.5%. So the interest rate is slightly lower, but then this is the thing that no one ever talks about. If you're locked in on a 15-year, yes, you're going to get it paid off in 15 years. And yes, you're going to pay less in interest and the interest rate might be a little bit lower, but you're locked into a monthly payment that is substantially higher, significantly higher. And
It's going to be double, right? I mean,
nearly double.
yeah.
Nearly double. And so the thing that I have always pushed back on that, and the reason that I've pushed back on that so strongly, it's really 2 or 3-fold. Number one, if you have a 30-year, you still have the option and the ability to pay the loan off in 15 years. My loan, when I took it out in 2015, was a 30-year mortgage. I've always paid principal when I have the cash available. But, maybe it's Christmas season, or maybe I'm planning a trip for the summer and I want to redirect some of those funds. Maybe there was some type of family emergency. I still have the option of making that minimum payment. Now I try and make additional principal payments every month and every time that I can, but there have been months where it's like, you know what, I'm going to pause that. I'm just going to make the 30-year payment for a month or two, kind of get my feet back under me, and then I will start making those accelerated principal payments. No one ever talks about that.
One other thing I'm just thinking of is the qualification. I would think that if it is nearly double, just the ability to even qualify for a 15-year mortgage has got to be pretty rare. A lot of people that are already struggling right now with the higher interest rates just to qualify for a 30-year,
Yeah.
I feel like that's got to be a big issue for a lot of people too.
Yeah, we're already in places like Denver where we're at. We're already having and experiencing an affordability crisis. So when you factor in higher home values, higher interest rates, increased property taxes, an insurance industry that's going through absolute chaos right now, and then you put that on a 15-year term versus a 30, I mean, affordability and just qualifying are going to be a really, really big concern. And that's how underwriting is going to look at it. They're going to look at the minimum payment on a 15-year term, and the debt to income ratio, the housing ratio are all going to be calculated directly from that. So you're absolutely right. There is a qualifying concern. And that's what, one of my concerns with Dave is that sometimes you just got to get in the game. It doesn't need to be perfect. When I bought my first home, it was not a perfect scenario. I was in an FHA loan. I didn't have 20% saved. I only had a 3.5% down payment. Interest rates were a little bit higher at the time, but I still got in the game and still started building equity, which 15 years later now, since I bought my first home, has gotten me ahead light years from where I would have been otherwise. So I'm so thankful that I didn't wait until I had the 20% and could qualify for the 15-year fixed.
All right, let's jump into myth number 2.
Yeah, let's jump on to myth number 2 here. Another one of the big myths is you must put 20% down. Now, the reason that you want to put 20% down, or the reason that that is attractive, and this is what Dave is arguing, is because the amount that you're going to be financing is going to be lower. So your loan amount is going to be lower. You're going to have more equity in your property. And then you're also going to be able to avoid private mortgage insurance. All of those are positive things. I have no issue with the rationale behind putting 20% down. What I do have an issue with is that it's just not practical for most people. Right now, our average first time, a lot of first time home buyers, at least in our market, are spending around 500,000. In some cases, 600,000 or more. So for them, if they were waiting to put 20% down, they would have to wait until they have over $100,000 saved. And if you're a first time home buyer, for most people, 99% of the people, it's just not going to be realistic unless you're getting some type of gift, inheritance. Now, if you already own a property and you have equity built up and you're going to be selling that and rolling that in, that story is a little bit different. I'm talking more to the first time home buyers here. But yeah, you don't need to put 20% down. What you do need to do, in my opinion, is see what your options are. What programs are you eligible for? Are you eligible for any down payment assistance, reduced down payment? Figure out what that number would be. Look at what the monthly payment would be, analyze it from an affordability perspective, and then just ask yourself, is this something that I can afford? Am I comfortable with this monthly mortgage payment? Is it in line with what my other goals and expectations are? And make your decision from there, not just the blanket 20% down.
So jumping into number 3, another one that Dave frequently says is that he really suggests to always avoid always avoid ARMs, or adjustable rate mortgages. So modern adjustable rate mortgages are definitely strategic, not traps, in my opinion. These lower initial payments allow people to, hopefully just get in the game, like Ben's saying, and have ownership now rather than kicking the can down the road for another 5 years and hoping that then they might be able to, make it happen. I think more importantly too, though, to understand that most people really don't even stay in a mortgage for 30 years. Just the average time that people currently own their home. I know for a while it was somewhere between like 6 and 8 years. I think now it's actually pushed a little bit longer to, I think, like 10 to 12 years is the average length that somebody owns a home. So just thinking through that, if that's roughly the average, people are going to be maybe going through 3 homes in the time of that 30-year span that they're not going to need it for. So just something to think about. I think Dave, though, is definitely really passionate about this one, and there's 2 sides to this story.
Oh, he definitely is, and I think America still has PTSD from what happened in 2007, 2008 with the Great American Recession and the housing crash, where ARMs just got such a those were such toxic ARMs. A lot of them were negative AM. A lot of them had prepayment penalties, and those were really really bad ARMs. And the ones that caused the crash were subprime ARMs. What we're talking about, what I'm talking about, is finding an ARM or an adjustable rate mortgage that is going to meet your needs or goals. If you're someone that relocates, if you envision refinancing, maybe you're a military family and we have a friend of ours who, is stationed at different locations every 2 to 3 years. So he's constantly moving. When you think about it like that, Americans have been fed this 30-year fixed rate. No one's really ever questioned it. But, would you go pay for a lifetime gym membership if you were only going to use it for 1 or 2 years? That's kind of
That's
what
a
we're
good way to
doing
think of it.
with the 30-year fix.
Yeah.
All right, myth number 4, you don't buy if you have any other debt. And Dave makes the point that, you don't want to buy until you are completely debt free. No auto loans, no student loans. All credit cards have been paid out. You've saved your 20% down. You have your emergency fund. You're following through on the baby steps. Again, those are all very, very positive things, but I don't know how practical they are. There is a big difference between being debt free and financially ready. Smart borrowers know how to manage debt, not avoid it blindly. And owning a home responsibly is possible even with other debt. You can still own a home and have a car loan. You can still own a home and have some student loans. It is possible. So again, the goal shouldn't be to be necessarily to be debt free. It should be, am I able to manage the debt that I have responsibly? And does this mortgage fit in with my overall financial profile?
I feel like Dave, when he really got popular back, in the 90s, where it wasn't even a YouTube channel or video, it was just audio. It was a radio show that he had. But back then, the ratio of what people were earning, so the median household income in comparison to the median price of homes, was much, much more manageable and similar. In today's market, it's just so dramatically different in states like Denver, where it's just almost impossible to really take what he's saying and apply it to markets like Denver. It's just so
Yeah.
unrealistic, in my opinion.
Yeah, I'm so glad that you brought that up because, like, my mom, for example, who purchased a home here in Wheat Ridge, Colorado in the mid 90s, single mom, single income, raising 3 boys, working part-time as a nurse, and she was able to qualify and purchase a home on her home, on her own. Not in a nice area, nice house, nice community, and she was able to do that. That same person in 2025 in Denver, single mom, working part-time, single income, there's no way, not even remotely close.
All right. So, myth number 5, your home is not an investment. So, for most Americans, it's definitely their number one wealth building tool. There's some crazy statistics out there about the net worth of somebody that rents versus owns. I think the last time I saw this statistic, it was renters was like $2,000 net worth, where homeowners were, I think it was like 300 and some thousand. Does that
Yeah, I
sound
think
right,
I think
Ben?
that's right.
Yeah,
Yeah.
it's crazy. But Ramsey really downplays the equity gains, but really the numbers just they don't lie. Owning beats renting in the long game, pretty much in every market out there. And I would just argue that anybody that's pushing back on that, again, the long game is what's really important here. Yeah, it might be more expensive. There might be more obstacles currently, but still getting in the game and letting the game work for you, the market work for you over the long haul, you're going to come out ahead versus renting. No questions asked.
Yeah, and Grant Cardone and Robert Kiyosaki have said this same thing, that your home is not an asset, the home that you live in. And I've always pushed back on that with
Definitely.
them as well. If we're talking like luxury properties and you're talking about a $10 million home, like fine, I can understand that. But the primary residence is the primary net worth vehicle tool of the middle class. And that is the reason that is what allows them to take advantage of all of these different opportunities, especially for the middle class. It stabilizes their housing expense. It gives them an opportunity to build equity. The way that our tax code is written, you can sell your primary residence every 2 out of 5 years as long as you've lived there. And if you're a single tax filer, the first $250,000 in capital gains is tax exempt. If you're married, it's up to 500,000. So you can go sell a home if you're married, if you've owned it for 4 or 5 years, and walk away with hundreds of thousands of dollars and not get taxed on it. Roll that into your next home or other investments like that. That is an investment.
Mm-hmm. Yep, 100% agree. Let's before we move on to myth number 6, Ben, why don't you share with the audience who our sponsor of the week is?
Yes, our sponsor of the week. This episode is brought to you by the upcoming free live real estate masterclass hosted by yours truly, Adam Sells Denver and American Money 101. Whether you're buying your first home or trying to outsmart the current market, we'll walk you through the smartest strategies real clients are using right now to win. It's free? Check. It's live, it's online. Double check. And it's 100% focused on helping you buy smart, not just outdated advice. Dave Ramsey. Save your spot now at webinar.adamsellsdenver.com.
All right. As always, thank you so much for our sponsors of the show. We couldn't do this without you. So moving right in, myth number 6. Stick to the 20. What were you saying, Ben?
Oh, I'm sorry. Go ahead.
Stick to the 25%. Oh, I'm sorry, Ben. This is actually yours, but
well, since you let the cat out of the bag, let me just say this. Myth number 6, stick to the 25% take-home rule. Now, this right here is one of the most outrageous things out there. When you think about it, when you combine high interest rates and a 15-year mortgage, and it can't be more than 25% of your take-home pay, not your gross pay, your take-home pay. Who qualifies for that?
So take home meaning before taxes?
No, take home after taxes. So mortgage lenders always qualify you off of your gross pay. And this is why this is so outrageous. So your gross pay is your salary. Let's say that your job pays you a salary of $100,000 annually. I'm just making this up. That's your salary, but that's not what's deposited into your bank every month. You're going to pay federal income tax, state income tax, Medicare, Social Security. You're probably contributing to your 401k. A lot of times it's not uncommon. if you're, you might only get 60 to 65 cents on the dollar of whatever your salary is. So if you're getting, let's say, your salary is 100,000, that comes out to a little over 8,000 a month. You might only get 5,000 a month that's going into your bank account. And then your mortgage payment, including taxes, insurance, HOA, can't surpass 25%. That is on a 15-year with high interest rates. That's insane.
So what is the number that, for example, a Grant Cardone would say? Is it more like 45%, somewhere around there?
Yeah, I mean, the biggest difference with lending institutions, like an FHA mortgage, for example, will go up to 46%, but that's based off of your gross income, not your net. So Dave is talking about using that net, the amount that gets deposited into your bank, where mortgage companies will actually qualify you off, or lenders will actually qualify you off of your gross, and they'll use a much higher percentage. Now, again, it all comes down to affordability. There are going to be certain debts and certain things that don't show up on credit that that you're going to have to pay. Childcare could be an example. So your lender is going to qualify you off of what is on your credit report. They're going to qualify you off of your gross income, but that's where you want to really ask yourself those questions about affordability. What am I comfortable affording? What can I afford every month? What am I comfortable paying?
So running into now myth number 7, FHA loans are a trap. So, there's definitely two sides on this story. FHA is definitely not perfect, but it is definitely also very, very powerful. It's designed to definitely help people start, just not be perfect. It's a great stepping stone for a lot of people. Ben, I think you had a personal story of either, was it you using an FHA loan or one of your clients recently?
Yeah, I mean, I love sharing my first time homebuyer
Mm-hmm.
story. I bought my first home in Phoenix, Arizona in 2010. I bought the home for $130,000. I took out an FHA loan. I put 3.5% down. I got a little bit of that of assistance from my mom in the form of a gift. So my personal out of pocket was close to $3,500. I turned around and refinanced that into a conventional loan about 2 years later to get rid of the mortgage insurance. From there, I sold that property in 2015. I walked away with $70,000 in net proceeds that I didn't have to pay taxes on. So my initial investment in 2010 was $3,500, sold the property in 2015, got $70,000 in net proceeds, didn't have to pay taxes on that, rolled that into my Denver property, purchased a property here in Denver in 2015, and now that property is doubled in value. So that $3,500 investment in 2010 is literally now worth over $500,000 just 10 years later in 2025. Does that sound like an investment to you?
Sounds amazing. It's like a Bitcoin, but legit.
Yeah, because according to Dave, it's not an investment. And the whole reason I was able to get into homeownership was because of an FHA loan.
Yep.
Otherwise, I wouldn't have qualified. Myth number 8, pay off your mortgage as soon as possible. Now, is there value in liquidity? Yeah, absolutely. In fact, I just spoke to someone today. Whose home was paid off, but he can't pay his bills. He just missed 2 credit card payments, the minimum payment. His score went into the 500s. So he has his home paid off, but he has a cash flow crisis. And that's what people don't always understand. You are house rich. What's the expression? You're house
House
rich, real
poor.
life poor.
Yeah.
So he has his mortgage paid off. He has his asset. There's no debt on that. Congratulations. But or would you rather have a reasonable mortgage payment, but then you can pay your other bills?
Yeah. Yeah. Just think, what's the credit card percentage rate on that loan? APR, probably what, 18%, maybe even higher, maybe 20%, versus maybe if he were to have a mortgage on the home, maybe what, 4%, 5%. I mean, just compare those two.
I know. And that's where, that's another area where, again, I want to pay off my mortgage faster, but I'm also on a 30-year fixed. I'm not on a 15-year fixed. I value financial flexibility more. I would rather not have my home paid off and have more options and have more flexibility and have my emergency fund. Life doesn't ask for permission. Your teenager doesn't ask before they take your credit card and run up a fast snacks bill somewhere without your permission. Thank you, fraud protection.
Yeah. All right. So let's wrap this up, you guys. Myth number 9. Dave definitely is known to say, never borrow against your home. Well, that's great, Dave, but we've personally seen doing this be an incredible wealth building tool, especially utilizing HELOCs, home equity lines of credit. So a HELOC is basically a revolving credit that you have against your house. Your house is the collateral for the loan, and this is just a great opportunity to use your home as a tool to borrow against. So HELOCs are just, probably the most commonly used example of this. But more importantly, they can also be a great financial safety net. Like Ben was just saying, rather than being up against a wall without too many other solutions or outcomes to, or I should say, ways to get around certain issues that might come up unexpectedly, like your son running up a bill at fast snacks. There's just, more opportunity when you have this as an option in your tool belt, if nothing else. And the best time to get one is when you don't need it. So, another thing to think about is if you wait to, apply for a HELOC and don't do it until you're drained out of any savings that you have, and you've got these looming bills that are starting to pile up. Well, the bank isn't going to offer you the HELOC at that point because you're higher risks. The best time to do this is when you don't need it, when you're in a very safe, stable environment financially.
Yeah, and this is one of the points where I just have a polar opposite view of Dave on this one. I believe that if you have any equity at all in your home, you need to have a home equity line of credit set up. It's not so you can go fund a dream vacation, so you can go travel the world, so you can go buy the boat or upgrade your vehicle. It's not so you can do any of those things. That would be incredibly irresponsible. What it is for is so that you can be prepared for life's storms. The storm is coming. It's not a question of if, it's when. And the point that you just made, the number one mistake that people make when it comes to situations like this is they wait until the storm comes, or they already lost a job, or they lost hours at work, or there was some type of medical emergency. Maybe somebody in the family passed, God forbid. But they wait until those things happen and then they make the call. Well, us as the lender, we can't qualify you if you don't have a source of income. You've already maxed out all your credit cards. Your scores dropped 150 points. I actually had a conversation with a customer last week. He has about $400,000 of equity in his home. He waited to call, though, until all of his credit cards are maxed out. And now he does, typically for a home equity line of credit, you need to have a higher credit score because it's in subordinate lien position, meaning it's subordinate to the first mortgage. So the credit score requirements are higher, typically like 680 to 700. This individual, though, his score had dropped because he maxed out all of his credit cards. So he didn't qualify for the home equity line of credit. So you have to set it up in advance for when you don't need it. So when you do, it's already there. And that's just how money works.
Quick question before we close this episode out. I buy a house tomorrow. How long do I need to wait before I can apply for a HELOC? Is there a minimum that the home must be owned before applying for this, or can it be done a month after owning the house?
It depends if the equity in the property is above and beyond what you paid for it. So in some cases, you might find a gem. Say the property, say you paid $500,000 for it, but it's actually worth $750,000. In cases like that, there are some banks that will have seasoning or waiting periods before you can borrow against that increased value. What my brother and I did, though, I know that I've shared this story with you, but we bought a duplex about a year and a half ago out in Tulsa, Oklahoma, got a screaming deal on it, paid about $200,000 for it. It was worth $300,000. We went to the bank, right after closing, and they opened up a line of credit based off of the increased value the actual value of the property, and we were able to get a line of credit based off of that collateral. So there are ways to do it immediately if the equity is there. All right. Well, as we wrap up here, just kind of want to recap some of the key takeaways. And again, this isn't about being disrespectful. Dave has helped a generation, and his principles and his values are sound, they're solid, but his mortgage advice has not kept up. It is dated, it is stuck back in the 90s. One size does not fit all and does not work in a high-priced, high-rate, inflation-heavy world. Smart buyers in 2025 need flexibility, liquidity, and tools, not slogans.
Absolutely. I think this was a really helpful episode, just to kind of reminded me of a few of these things that Dave is so, staunch about, that just, man, just more I think about it, just how irrelevant it is in today's market now more than ever. But you guys, if this episode made you rethink at all about what you've been told about mortgages in the past, then good. We did it. We did the right job today. We made it happen. Don't sit on the sidelines waiting for the perfect setup. Get informed, get strategic, and just make sure you take ownership of the future. And, as always, thank you for joining us. Pursuit of Progress podcast. We're now on season 2. We're coming up on 100 episodes later this year. If this episode specifically sparked anything within you today, do us a solid, share it with a friend. Maybe they're stuck in this Ramsey mode themselves. Help them get out of it. And make sure you subscribe, leave us a review, and stay tuned because we are just getting started. Excited to share a brand new episode with you guys next week on the Pursuit of Progress podcast. I'm Adam, and as always, here with my co-host Ben. We'll see you guys next week.
We love you guys. We'll see you next week.